We're going to go deep into everything you need to know about using an SBA loan to buy a business. This is going to be a long one. We're going to cover everything. You might want to save this for later. We're going to cover your required net worth. We're going to cover the credit score that you need. We're going to cover your work experience. We're going to talk about interest rates. We're going to talk about down payment requirements. We're going to cover licensings, real estate, and debt service coverage. All of it. First, when people say SBA loan, we're talking about loans backed by the Small Business Administration. And what these are loans that are offered by banks, but the government provides the bank with a guarantee in the case of default. So that means that the lender is going to be much more willing to take a risk on you and your business. So the SBA does not give out loans, banks do. Now there are different types of SBA loans, but we're going to cover the most popular, the 7A program. Through this program, you can borrow up to $5 million at either 10-year term to buy a business or 25-year term to buy owner-occupied real estate. And that limit applies to both the entity and the person taking out the loan. So for example, if you have two people buying one business, the max is still going to be $5 million. And then also the cap is limited by household. So if you take out a $5 million loan, your spouse can't go and take out an additional $5 million loan. Probably one of the biggest misconceptions is that you need to have a lot of personal assets or a lot of personal liquidity to take out one of these loans, and that's just not true. Now, there are some lenders out there that require you to have a certain net worth or a certain amount of personal collateral, but there are plenty of lenders that don't require that. And even within the SOP of the SBA, they really discourage that. They say that the whole purpose of this program is to make capital available to underserved individuals. So obviously requiring you to have $1 million of net worth is going to lock a lot of people out of the market. So if you run into a lender that's requiring you to have a lot of personal assets, just find a different lender. We've done several $5 million deals with people with virtually zero personal assets. Also, cash on hand. You don't need to have a lot of cash on hand beyond the required down payment or equity injection. What will happen is that you can get the capital you need, the working capital that you need to run the business through either the SBA loan. Typically you can borrow up to $500,000 in additional funding in just cash that you would use to fund the business. And then you can also work something out with the seller. So if you have a business that needs $1.5 million of working capital, you could say, tell the seller, give me $1 million of accounts receivable, and then go and get $500,000 from the bank. And now you have $1.5 million that you need to run the business. So the only cash you really need going into the deal is that down payment or equity injection. So technically the required down payment is 10% for an SBA backed loan, but that 10% doesn't have to come from you, the buyer. It can come from the seller in either the form of them rolling equity into the new business, meaning if they only sell you 90% of the company and they keep 10, that down payment's been made. They can also provide it through a seller's note as long as that note is on standby for 24 months. So meaning that there's no principal or interest payments for the first 24 months of the loan. So it's important to note that the SBA will allow zero down payment loans, but most lenders won't. They do have discretion on what they're going to require to come from the buyer. So typically what we're seeing from our banks is it's 0% down if you are a manager buying out a company that you currently work for. It's 2.5% down if you're buying within an industry that you have over 2 years of experience. And it's 5% down for most other things, meaning that the rest of that 10% needs to come from the seller through that seller note or that equity rolling into the new company. Different banks have different criteria. Some banks will allow all of that down payment that's required by the buyer to come from investors. Some banks won't. Some banks maybe want to see 1% come from the buyer. They all have different rules around that, but the lenders that we work with the most, that's their requirements. Now, you don't need perfect credit. Generally looking for a credit score of 680 or better. If you have a credit score a little bit lower than 680, you can make up for it by every other aspect of the deal being really strong. So the debt service ratio or the cash that the business is kicking off is really strong. Your background is a really perfect fit. You can make up for having a weak credit score if the deal is strong in other areas. But if you're much below 650, it's probably going to be tough. You might want to focus on some credit repair before you go out and try to get a loan. So most SBA loans carry a variable rate that's based on the Wall Street Journal prime rate plus either 2.5% or 3%. Your payments will get adjusted quarterly, and that Wall Street Journal prime rate is highly influenced by the Federal Reserve's Fed funds rate. So when you hear them talking about the Fed raising or lowering rates, that usually goes directly into that SBA loan. And to learn what the rate is today, just go to Google, type in WSJ prime rate. It'll pop right up. Real estate. SBA loans can be used to purchase owner-occupied real estate, but they cannot be used for investment property. And owner-occupied means that your business is going to occupy the space. Now, the term for owner-occupied is 25 years versus 10, and often you can get that with 0% down. And when we say no investment property, so we mean you can't use it to go buy an Airbnb, can't go and buy a single family long-term rental. You can't go and buy apartment buildings. There are FHA and other government-backed loans that are better for those purposes. I think Fannie and Freddie have some programs. The SBA is not the venue you want to go for that, but there are some types of real estate that you can do that might be thought of as investment properties. So storage or hotels. Essentially, the storage business or the hotel business is going to be operating out of the building. So you can typically get an SBA loan for those types of properties. You're going to buy something like a office building or strip mall. Your company needs to occupy the majority of the space. So if you buy an office building and your employees are going to occupy 80% of the building and you're going to rent the other 20, you'd likely be able to get that loan through. Similar with the strip mall, if your business operated, say, 70 or 80% of the space and you're going to rent out the rest, that would likely count as an owner-occupied property. Now, the most important factor in SBA loan is going to be your work experience. You need to show the lender that you have the skills needed to run this business. And if you don't, you need to find a partner that does have those skills, and you're probably gonna need to give them 10 to 15% equity to get the deal done. And then if you're buying a business that requires some type of licensing, this can get tricky. The bank doesn't want you to use the previous owner's license unless they are rolling equity into the business. You can also find a key employee that can hold the license for the business. If you're doing this as a temporary solution, you need to have some type of employment contract with a bonus structure in place until you can get your license. If you're planning to have them hold the license in perpetuity, then you should give them some equity, 10 to 15%. Now let's focus on one of the tough ones, the debt service coverage ratio, the DSCR. This is going to be a big factor in whether you're going to be able to do your loan or not. This is just a measure of the business's ability to cover the debt payment. So most banks require a minimum debt service coverage ratio of 1.25, meaning that the business generates 125% of the cash flow needed to make the debt payment. Now that's the minimum. We would want to see something much higher to feel comfortable going into a deal. Now we made a great free tool for you to calculate the DSCR for your deals. Just go to owneractions.com/DSCR or check it out in the comments. Now the hardest part about figuring out the debt service coverage ratio is that you need to figure out the CapEx. So that is the amount of money that the business needs to spend just to keep going. So say if you had 10 trucks, you're gonna need to buy a new truck every year. So the CapEx is gonna be the price of a truck. And really at first, when you're first looking at a business, maybe you're first looking online, just take a guess. If they're using a lot of heavy machinery, that number is gonna be big. If they don't have any equipment or machinery, that number is gonna be small. Just start with a guess to fill in the numbers initially. And then as you're working with the seller through the process, try to fine tune that number. So ask them, how much do you spend? What do they think is a reasonable number? You can look at the depreciation in the past as a clue, because when you buy a piece of equipment, when you do your CapEx spending, that gets depreciated, and that's how that flows through the income statement. There were some issues with tax years where people got extra high tax benefits for buying assets. So people bought a lot of assets in, say, 2022 to try to maximize that benefit. So you need to level that out across multiple years. Then you need to know your minimum salary. So that's going to come into the debt service ratio. So this isn't the amount that you want to make, or this isn't what you need to live comfortably. This is just the minimum you need to just make your mortgage payment, your car payment, your student loan payments, really just to service your debt. So the bank is going to calculate what they think is a minimum salary that you need and use that in calculating the debt service ratio. Again, this isn't the salary you're actually going to take. It's just in calculating that debt service coverage ratio. Lastly, let's talk pre-approval. Now, pre-approvals don't really have a lot of weight because it's really more important about the business. The factors that are related to you just aren't really that important of the loan, except for your work experience. And obviously your work experience is going to depend on what the business is. But there are sellers and brokers out there that really want to see pre-approvals. They might demand it to try to talk to a seller. So there are some banks that will give pre-approvals that will just look at your credit score and your down payment and kind of give you a letter that says you could take out a loan to X amount. We also have a basic pre-approval process that we can say, we can give you a letter that says that we think you can get a loan up to X amount within our lender network. You just go to owneractions.com/pre-approval. Again, link in the comment. And if you need anything else, we're here to help. Check out the links in our bio to see different ways that we can help you buy your business.